Hello, in this video we'll discuss the alternative minimum tax. Now this is meant to be a basic discussion regarding the AMT, and in no way is this meant to be an exhaustive understanding of every single concept with respect to the AMT. I also want to make sure to emphasize that the AMT has changed many times over the years, and there's been some big changes with the Tax Cuts and Jobs Act of 2017 and going forward. So the beginning of this discussion and the general discussion is going to be since the inception until the Tax Cuts and Jobs Act. In the last few minutes, I'm going to switch over. I'm going to talk about the Tax Cuts and Jobs Act and how that's affected the AMT. Now, the AMT is really important because it's one of those things in tax that not many people understand. They understand, okay, well, it's something to do with we have wealthy taxpayers and maybe they're paying a lower rate than not so wealthy taxpayers are, and it's a way to try to level the playing field, make them pay their fair share, that type of idea. But the actual implementation and how it works is another discussion. So with that, let's jump right into it. What is the AMT? The AMT is, think of it like it's part of the income tax, but it's actually separate. So when we do our income tax calculation for individuals, corporations, estates, and trusts, we have to do the normal income tax calculation. But at the end of our determination, on the side as a parallel structure, we also have to calculate the AMT. And the idea is that if the AMT results in a higher amount of tax, that difference between what the income tax, the normal income tax, and the AMT, the difference has to be added to the income tax to make sure that the individual, the corporation, or the estate or trust are paying the amount that the AMT would result in if the AMT results in a higher amount than the normal income tax. That's the idea. Now, when did the AMT come about? It came about in the late 1960s. And the idea with the AMT, the alternative minimum tax, just like it sounds, it wants to make sure that certain taxpayers pay a minimum tax. The idea is that if you think about our tax system in many different regards, two regards I want to focus on. First is think about all the various deductions and exclusions from income that we have. A lot of those deductions and exclusions from income might only benefit a certain type of taxpayer, mainly a wealthy taxpayer. Take, for example, the exclusion of municipal bond interest. What taxpayer is going to benefit from municipal bond interest being excluded? Do you think low-income taxpayers? Well, possibly, but as we know, most taxpayers that have lots of investments usually have a higher income. They're not in the lower income set usually. They might be in the lower income set, but they're almost always in the higher income set. So that's something that if you have municipal bond interest, you get excluded from gross income. That's going to benefit usually a high income taxpayer. That's very important to understand. So the second thing is that think about the tax rates. We have the ordinary tax rates, but we also have preferential rates for long-term capital gains and other special gains out there. Who usually benefits from long-term capital gains? Well, a lot of times when you're talking about investments and capital property, right, selling stocks, selling bonds, that usually, again, is wealthy taxpayers for the same reason I mentioned about the exclusions and deductions. So the idea is that, let's say you have a person that's a billionaire and has income over $100 million each year. And then you also have a person that, let's say, makes $50,000 a year. The $50,000 a year person might be subject to, just making up some numbers here, they might be subject to a 20% tax rate, the highest tax rate. But the person that makes $100 million a year, due to exclusions, deductions, and the lower capital gains rates, their effective rate might actually be 18%. So they might actually pay a less percent than the person that makes $50,000 a year. Now that's just, again, an example. I'm not saying that, based on when you're watching this video, that's what the rules are and, how it works out. But it is possible. That has happened in the past. Warren Buffett, famous billionaire, at one time said that his secretary pays a higher tax rate on her ordinary income, obviously, that's implied, than his effective rate is. She might pay 30 to 40% on her income, but he's paying less than 20% on all of his income because he has lots of capital gains and exclusions and whatnot and deductions out there. Is it fair? So the AMT is all about that equity prong when it comes to looking at tax policy. Now, again, I want to focus on AMT changes so frequently. again, this came about in the late 60s, again, because a lot of wealthy taxpayers were paying less than middle class and lower class people, so it became an issue. So we had this alternative parallel system in place that went along with the income tax. And again, it's important to understand, it applies to both individuals, corporations, and also applies to estates and trusts. So it's not just individuals, it's also corporations, estates, or trusts, okay? So it's very important to understand that when you're watching this video, the AMT rules might have changed. So I'm just going to keep this as general as possible. It's also understand that when you're watching this video, it might be repealed. Now, at the time of this video, it's still in place. Even if it's repealed, you still have to know about the AMT because this is something that could come back in the future. So you need to keep track of the AMT and the idea, because this is something that, even though there's a lot of discussion, let's get rid of it because it's so complex. It's just another way to make our system complex, the simplicity argument. Well, again, it's very much something that there's lots of arguments for having it and against having it. So this is definitely something that if it's ever repealed in the future, you could eventually see it come back again in the future. It's not going to be gone for good. So the AMT computation reconciles taxable income through adjustments and preferences, which I'll mention those, with alternative minimum taxable income. So the idea again is that you calculate taxable income, and then when you're done calculating taxable income and you calculate the amount of tax due or tax owed, tax liability, then you also calculate this side tax, the AMT, and if the AMT is higher for that individual, you have to add on the difference between the amount of tax under the income tax system, the normal tax system, and the AMT, and you add that to the income tax. So it's kind of like a way to make sure that the individual is paying a minimum tax, if you will. So this is by far the most important slide. Please make sure that you note this. So I know I mentioned that these the adjustments, preferences, the rates, the exemption amount, credits, they change frequently. However, the structure of the AMT usually stays the same. So what we do is that we start with regular taxable income, and that's after we add back the standard deduction and personal or dependency exemption. So you're not allowed to take those under the AMT, so you add those back in. We add or subtract any adjustments. We're going to talk about what adjustments are in general in a few minutes, and then we're going to talk about some of the major ones. But when you think of adjustments, think mostly about timing issues. Areas where maybe under the normal income tax calculation, you normally take something accelerated like depreciation. Well, for AMT purposes, we're actually going to extend that out so you don't get as much benefit early on, but it's more extended out. Like instead of like double decline balance, you get like straight line under certain depreciation systems, that type of thing. So it really balances out in the long run. That's most adjustments. There are some adjustments that don't involve timing issues, but it's mostly timing issues. Preferences only are added. So adjustments are added or subtracted. By the way, if you're adding, that's increasing the taxable income. It's going to increase the potential amount of the AMT. If you're subtracting, that's obviously good. That's going to lower the amount of potential AMT. Okay? So, and the reason that adjustments go up or go down is because, again, we're looking at timing and it has to balance out over time compared to the income tax. So one year you might be adding a certain item and the next year you might be subtracting it because it might have flipped when it comes to the income tax system. Preferences are only added. Now, when you think of preferences, usually what we're talking about here is items that really only benefit wealthy or businesses that get certain benefit, and we're adding them back. It's only added back, and it's usually exclusions or deductions. It's not a timing issue. So it's usually more of a, we call permanent item. So we take regular taxable income, adding back any standard deduction or personal exemptions, plus or minus any adjustments, plus preferences. That gives us our AMTI. We subtract away the AMT exemption, which that amount can change. That equals our alternative minimum tax base. We multiply by the rate, which the rate has never historically been more than the highest ordinary income tax rate. It's been equal at one time, but it's never gone above the ordinary income tax rate, and usually it's well below. So at the time of this video, the highest tax rate is 39.6% for ordinary income, and the highest AMT rate is 28%. That's the time of this video. That changes. A few years ago, it was 25%. It changes. Okay? And that, we multiply, equals our tentative minimum tax before credits. Then we subtract away any AMT foreign tax credit or other credits that are allowed under the AMT. And that equals our tentative minimum tax. Then we subtract away any regular tax liability under the normal tax structure. And then if that's a positive number, then it's considered the alternative minimum tax, which gets put onto the tax return. Because the idea is that you're subtracting away the tentative minimum tax from the regular tax liability you've calculated under that normal income tax structure. So if it's a positive number, you have to pay that amount. If it's a negative, you don't have to pay. You just pay whatever's on your tax return. You don't get a negative. You don't get to subtract away. The alternative minimum tax can only be 0 or a positive number. It can never be negative. Okay. So most AMT adjustments relate to timing differences. We talked about that. And by timing differences, the best example I can give you is depreciation, which is a major one. So if you're thinking about depreciation, there's different types of depreciation methods. Most companies, for financial accounting purposes, use straight line, right? So if you depreciate property over 5 years, you take the amount of the depreciable amount divided by 5 years. But for tax purposes, most depreciation actually occurs through maker's double declining balance, which double declining balance is another tax system, and that's for a normal tax. Well, some items might be for normal tax might be allowed double declining balance, but for AMT purposes might have to be done straight line over a period of time. It's timing difference because you're still taking the same amount of depreciation, whether it's under the normal tax system or the normal income tax system or the AMT system. Okay? Another example is circulation expenditures, which circulation expenditures relate to periodical items like newspapers, magazines, and whatnot. Now, certain AMT adjustments do not relate to timing differences. These are permanent, but most of them, that's not the case. It's almost always a timing issue, like depreciation or circulation expenditures. Now, some examples of adjustments that are not timing differences, but permanent difference. So a timing difference is temporary because, again, it's more about when you take it. It's going to be the same amount over the period of time. Permanent differences are not that way. You just don't get them or you get them. So perfect example is itemized deduction. Some itemized deductions just aren't allowed for AMT purposes, and we'll talk about some of those later on. AMT preferences, again, are always added. So the AMT adjustments can be added or subtracted depending on the circumstances. The AMT preferences are going to always be added. And these are designed to take back all or part of the tax benefits obtained by certain items in the computation of taxable income for regular income tax purposes. And some of the preferences include, and we'll talk about these briefly, percentage depletion in excess of basis, excess intangible drilling costs, interest on certain private activity bonds, excess accelerated over straight line depreciation on real and leased personal property, and 7% of the exclusion from gross income of gains on the sale of certain small business stock, which is a special rule. Now, again, I want to highlight some stuff before we talk about and go in detail on these AMT adjustments and preferences. These things change. So at the time of this video, these things could be different than when you're watching in the future. So you really got to look at this. Now, I'm highlighting the big ones, the major ones that really haven't changed over time. So again, some of these could change, but I'm going to keep it as general as possible so that way you're not pigeonholed into learning the specific rules. But if you do want to know specific rules, please look up your specific year because, again, these do change quite often. When you're taking, for example, the CPA exam, if you're in a law class or an accounting class, most instructors and professors in the CPA exam, they love to keep the AMT issue very, very, very broad. They like to ask more conceptual issues. Like if we go back a few slides, what's the structure? What is an adjustment versus what is a preference? You subtract away the AMT exemption. You're not going to usually be tested on specific numbers. Like, oh, they're not going to say, what is the AMT exemption in 2017 or 2022? Okay, they're not going to ask that. It's going to be more conceptual, like what is the purpose of the AMT, and maybe some general AMT preferences and adjustments that, again, have been around for a long time. Like, for example, adjustments, a lot of depreciation adjustments are out there. So depreciation might be an example. Okay, so really the idea is that this presentation is meant to get you thinking about this conceptually and generally. And if I ask any questions on an exam, again, I ask very, very, very conceptual questions. You're not going to have to make any major calculations or do any, calculate the actual AMT. Now, as I mentioned, there's an exemption amount. So the exemption amount reduces the AMTI, the alternative minimum taxable income, to arrive at the base on which AMT is computed. And then, of course, we subtract away any credits. The exemption is phased out when the AMTI exceeds certain amounts. Because obviously the higher taxpayer, you shouldn't be getting this type of benefit, just like we have in our normal tax system. So just like in the normal tax system, the AMTI has very similar traits, Like if you're wealthy, you have a phase out of a lot of the items. Like just like for example, you don't get to take a standard deduction or itemized deductions if your income is high under the normal income tax system. The AMT rates are a progressive rate structure just like the ordinary income rates. Again, I'm not going to go into the specificity of that because it changes frequently. And there are rates based on capital gains and capital losses. The net capital gain and qualified dividend income, they have they're taxed at the favorable alternative tax rates, which are very similar to the preferential rates that we see in the income tax system, right, for long-term capital gains and whatnot. Okay, so let's talk about AMT adjustments. So again, AMT adjustments, think about temporary timing issues. Not all of them, but most of them. And remember, these can be added or subtracted from the taxable income to get to your AMTI, okay? Depreciation is a major example of a timing difference, and there are many special rules depending on when a specific type of property is placed in service. And what kind of property is it? Is it real? Is it personal? Certain types of personal property in certain industries have different rules. When was it placed in service? Was it placed in service back in the 1990s, 1980s, 2000s? They have different rules. Very important to understand because we had different depreciation systems at different times under the normal tax system, income tax system. So depreciation is a big one. Pollution control facilities have some special rules that relate to depreciation and just in general pollution control facility type recovery. Circulation expenditures have a special rule to be added or subtracted. Again, we're talking about temporary items. And circulation expenditures deal with periodicals like newspapers, magazines, items that are published frequently in a normal subscription type service or whatnot. And that's what you're talking about when you talk about circulation expenditures, the expenditures that go into that. Mining, exploration, development costs, and research experimental expenditures. These are also considered some adjustment items that have to be adjusted when you're talking about calculating AMTI. Completed contract method. So we're talking about construction and contracts and whatnot, long-term contracts, the percentage of completion method and completed contract method. So AMT requires the use of percentage of completion rather than the for long-term contracts rather than completed contract method. So under the normal tax system, you can do that, but you can't do it for the AMTI, which that makes a timing difference because it's going to be the same. It's just when can you actually take into account these items for income recognition and deduction and whatnot. Incentive stock options, ISOs. The exercise of an ISO can cause income for AMT purposes that is not currently taxable for regular tax purposes. Again, this is a timing item. This is timing. Temporary item, it balances out over time, but it is a timing item. Adjusted gain or loss. So since the adjusted basis of an asset can be different for regular tax and AMT, I wonder how. Oh, depreciation, and obviously other things as well. Depreciation changes, reduces the basis. Well, if we have a different depreciation system for AMT purposes, we have to keep a different gain or loss calculation when we sell property for this purpose. So this could be something where you add more back if you didn't take enough depreciation for AMT purpose. So this is very important. You got to basically keep track of these gains or losses separately on an AMT schedule. And this is where you're starting to see, okay, well, I know that tax, anybody can do their own taxes. You don't have to be a CPA or an attorney to do to sign a tax return. You can be anyone. You can be your own taxpayer filing taxes. This is where things can get very muddy, and you might want to hire someone to do your taxes because things can get very challenging when you have to keep all these schedules using different rules. Passive activity losses. Passive activity losses are not deductible in computing either regular income tax or the AMT. Passive losses must still be recomputed, though, for AMT using AMT provision. So with all these rules for AMT, we have to calculate our passive loss, our passive income, passive loss, and it's possible that for income tax purposes, you can have calculated passive income, passive losses differently than AMT purpose, but you have to keep track of that separately, and that could result in an adjustment. So that's very important to understand, okay? Very, very, very important. So again, you have a parallel structure. A lot of things are different in calculation. A lot of it has to deal with these various cost recovery deductions like depreciation and whatnot. So very important. NOLs. NOLs have to be computed differently using an alternative tax NOL deduction calculation. So the starting point is in computing the alternative tax NOL deduction is the NOL computed for regular tax purposes and then modified for the AMT adjustments and tax preferences. So again, we have the depreciation in various things and other items that, and again, I haven't gone through all the different adjustments just because I'm going through the big ones, but there's various little things that can affect NOLs, passive losses, gains and losses, and it's important, again, to keep track of all this stuff separately. So you're seeing that having the AMT is an issue of, okay, we want fairness to make sure that the wealthy taxpayers are not paying a lesser percentage than the lower income taxpayers are, or the middle class taxpayers, because that wouldn't be very fair, especially when the wealthier taxpayers can afford to pay the tax. They don't really have as much pain in paying tax because they have tons of discretionary income. But then so that's one thing. You want this fairness, this equity issue. Okay, you want to make sure they pay their fair share. But on the other end, the wealthy people who usually end up getting hit with the alternative minimum tax, I mean, there's some people in the middle class, but it's almost always the wealthy people. They have a simplicity issue because their tax becomes way more complex, and we want to make sure the tax is simple to understand. And how can it be simple? And you have to calculate a second set of tax books, if you will, because you're doing the AMT calculations. Here's some adjustments that are not timing or temporary issues. These are more permanent. Itemized deductions that are allowed for AMT purposes include casualty losses, gambling, charitable contributions, medical, certain estate tax, and qualified interests relating to student loans, qualified residence, investment interests. Those are all allowed for AMT purposes. However, you can't deduct the normal taxes like real property taxes, sales taxes, state income tax. You can't take that for AMT purposes. And you also can't take miscellaneous itemized deductions that are subject to the 2% AGI limit. So these are the items like, for example, if you have employee business expenses, those kind of things. That's a huge area. The safe deposit boxes, the items that are subject to the 2% AGI limit. Clothing expenses for if you have certain clothing and whatnot. Again, it's important to understand that these are permanent. They're not temporary, meaning that you're never going to be able to take them. Gross income may include a refund of taxes deducted in prior years as an itemized deduction. This will be a negative AMT adjustment. This is allowed for such refunds for AMT purposes, so it's going to subtract. So gross income, you have to add that in when you get prior year's itemized deduction for the taxes related to it. That's the idea. It's kind of like a matching principle, the no double tax benefit item, but it's like matching. Well, because you can't deduct the state purposes, you get to add any refunds you had to include for state tax purposes. And the 3% cutback of regular income tax itemized deductions does not apply for AMT. Okay, you don't have to take that 3% cutback. Sometimes we call it the haircut provision. Other adjustments. So the AMT does not allow the standard deduction and any personal and dependency exemption. You have to add those back, and we saw that at the beginning of our formula. And there's lots and lots and lots of other adjustments out there that we have to adjust for, but these are just some of the really big ones. Let's talk about preferences. So preferences are always added back, and usually preferences tend to arise because of deductions or exclusions that provide substantial tax benefits, mostly to the very wealthy. Again, perfect example is municipal bond interest a lot of times. There's certain municipal bond interest that usually benefits the very wealthy. So unlike adjustments, preferences can only be positive, and preferences reduce the benefits initially received when computing regular tax. So they create more taxable income for the AMT purpose, the alternative minimum taxable income. It goes up from when you're calculating that through preferences. Percentage depletion is an example of preference. Now you're thinking, okay, wasn't that a timing? It's the amount beyond the adjusted basis gets added in. That gets added back in. So it's not simply a timing, it's just you have to add that back on, so that's a permanent item. Intangible drilling costs. They're usually deductible currently for regular tax, but the AMT is actually computed using a percentage, and again, usually ends up being a permanent because you don't get to take all of it, so it's not, again, a temporary or timing thing. That would be you still get the same amount, but just over a different period of time. This is more of a permanent thing because you use a formula. You see the formula there. Interest on private activity bonds. So as you know, for regular tax purposes, regular income tax purposes, you're allowed to exclude municipal bond interest, including most private activity bonds. However, for AMT purposes, you have to add back all private activity bond interest that was excluded from gross income. Very important to understand. Another one deals with the small business stock, which usually is a 50% exclusion, but 7% of the excluded amount is a tax preference for AMT, so you have to add back that portion. This is a really quirky one, just a way, again, because a lot of wealthy individuals take advantage of this provision, so we have to add back a portion of that. There are credits out there, AMT credits. AMT attributable to timing differences is a AMT credit. It's the excess of AMT over the AMT computed without timing differences. And the AMT credit can be carried forward indefinitely until the taxpayer dies to be used to offset regular income tax liability. You cannot carry it back or use against AMT liability. However, if you have a very large AMT carry forward and you don't think you're going to be able to utilize that ever for the rest of your life, you can always marry someone who does have high AMT, and they can utilize that through a married couple. I know it sounds interesting, a sham marriage, just to take advantage of the AMT carry forward, but we saw the same thing when you had the capital losses going forward, right? Remember, general rule is for capital losses, you can offset capital gains and up to $3,000 if you're an individual, and that might change in the future depending on when you're listening to this, but that's what it is at the time of this video. Well, if you don't feel like you're going to be able to utilize all that during your life, because again, it carries forward indefinitely until you die, well then you can marry someone that has a bunch of capital gains so you can offset it all. Same thing with AMT. If you marry someone that's expected to have lots of AMT in the future, well, maybe you cannot use it to offset. So the previous discussion has been pretty much consistent with how the alternative minimum tax has operated since the alternative minimum tax has been enacted. And really, there's only been some minor changes with respect to certain things. I mean, there's been things added, taken out, and whatnot, and the exemption amounts, they've all changed, and obviously the tax code of 1986 with that tax reform changed a lot of things with alternative minimum tax. But recently, with the Tax Cuts and Jobs Act of 2017, there's been some major changes with respect to alternative minimum tax. So really, the way to think about this is you should be learning the AMT from the previous discussion we just had, because that gives you the history and the general basics. And then after the Tax Cuts and Jobs Act of 2017, so starting in 2018, there's a few changes, and I'm just going to highlight on those certain changes, okay? And the main thing is that, remember in our discussion, I mentioned that corporations they are subject to the alternative minimum tax. Well, corporations starting in 2018, as a result of the Tax Cuts and Jobs Act of 2017, corporations are no longer subject to the alternative minimum tax. They're no longer subject to the AMT. So there's no AMT calculation done by corporations. So individuals, estates and trusts, you have to go through all of that. The other types of taxpayers, they all have to go through the AMT calculation. Okay, in the past it was individuals and corporations. They had to go through this. So now it's really just individuals and similar treated to individuals. Corporations are not subject to this. Now it's important to understand that if for corporations that did have some type of issue in the past with the AMT, like a minimum credit that might flow to a future year, be able to carry it forward, that still is important to understand. So starting in 2018, where tax years of a corporation, the beginning of the year starts in 2018, that's when the AMT for that tax year once that start takes place, so that ending tax year, so basically we're talking about December 31st, 2018 and going forward, those ending tax years, corporations are not subject to AMT. Again, though, if there are any minimum credits that are potentially from previous looming years prior to 2018, then you have to take that into account and how that operates. Okay, that's the first thing. The next thing I want to mention is that with some of the major changes to various provisions with the adjustments and preference items of the AMT, there have been some changes. And my point is that just like in this video, it's meant to be a basic discussion, and really it's not meant to just focus and memorize. It's just to give you an idea of kind of the general, the big hitters, the big provisions out there. So for example, various provision is that the Tax Cuts and Jobs Act of 2017, and this is just one example of many, medical expenses. The medical expense deduction after the Tax Cuts and Jobs Act of 2017, it affected the medical expense deduction. And before the Tax Cuts and Jobs Act, there was, if you remember that 7.5% or 10% AGI before the Tax Cuts and Jobs Act, that rule, well, there's a similar rule with the Tax Cuts and Jobs Act, but you don't have to worry about, recouping that portion over it with respect to the AMT. That does change. So various provisions from the Tax Cuts and Jobs Act, they changed, within the tax law, and because of that, the AMT had to adjust for that. The third item, and the last item I really want to focus on, is that those exemption amounts that I mentioned, which I didn't talk about the specifics because they've changed so much over the years, the exemption amounts after the Tax Cuts and Jobs Act, they significantly went up. They changed significantly, almost doubled from what it was in the previous year. And really, it's important to understand that they did go up, so less people in the middle class should be affected by the AMT, and hopefully more people in the upper class, but we'll see if that really happens, if you're looking at that or whatnot, or you can actually check that. And this really shows you that the main thing I want to stress is that corporations, as a result of the Tax Cuts and Jobs Act of 2017, are no longer subject to AMT. But before that, they were. It's really important to understand because going forward in the future, based on the year you're watching this video, it's possible that the law could change and they might be subject again. So you got to pay close attention, as well as the provisions. You got to pay attention to this. Again, this video is really just to give you an idea of how the AMT works, the structure, some ideas of kind of provisions that are added back. Most of them, like charitable contributions and whatnot, they affect certain, taxpayers. Medical expense deduction may affect certain taxpayers, and they get added back. Private activity bonds, the municipal bond interest, that affects certain taxpayers, and that gets added back in with respect to tax calculation. And then the exemption amounts, that was mainly, again, to, if you look at the history of the AMT, a lot of the middle class is affected by the AMT, actually more than the very wealthy taxpayers, and that was kind of an issue with the Tax Cuts and Jobs Act to kind of try to remedy that. So I really hope you've enjoyed this discussion. Again, after this, I recommend going and looking at your respective year to see what's going on with the AMT, and that will give you a general understanding of what's going on.